Today, we're diving into a really aggressive speculative analysis report on Safe Harbor Financial, SHFS. It's making a very strong case that, technical indicators might finally be signaling a bottom for this cannabis banking play.
And the core argument is powerful. You have net income profitability, which is, well, it's almost unheard of for a microcap like this.
Right, and you combine that with a $5 million market cap. The potential upside, especially if something like the Safer Banking Act moves forward, is just massive.
It is. That foundation profitability against that valuation is genuinely compelling. That massive disconnect is the entire reason to even look at the risk here.
Exactly.
However, the analysis successfully identifies this powerful macro catalyst and the fundamental value, but it really needs to better integrate that conviction with the highly tactical, very short-term trade plan it's suggesting. Okay, so let's dig into that. The material focuses on these super specific, immediate technical lines, the 137 intraday low as the absolute stop loss, the line in the sand,
and the 167 previous high as the breakout trigger. These are very, very specific entries and exits.
They are, but here's the weakness. There's a structural disconnect between the conviction you get from the valuation, this idea that the stock is, trading for peanuts, and the rigidity of the trade plan itself,
which is hinged purely on yesterday's chart.
Purely on yesterday's movements. So the fundamental argument about profitability is there, but it doesn't actually anchor that line in the sand. I mean, if the entire thesis is built on a huge valuation gap that implies 100, maybe 200% upside, why is all the risk defined solely by a recent blip on a chart?
That is a huge difference. You're shifting from just simple chart reading to a thesis-driven strategy where the technicals have to reflect a fundamental reality.
Yes.
But let's just contextualize that $5 million cap for a second. For a recently profitable bank, even a niche one like this, how significant is that valuation gap, really?
Oh, it's enormous. In traditional banking, or even just established microcaps, a profitable company trading at $5 million it's practically non-existent.
Unless there's some kind of immediate threat.
Right, like an immediate threat of insolvency or some catastrophic litigation, which the analysis doesn't suggest is happening here. This valuation is basically pricing in a 90% chance of failure, despite the fact it just posted positive net income.
So the stop loss shouldn't just be where the chart looks bad.
Exactly. It should be where the fundamentals that define this whole opportunity start to break down.
That makes complete sense. So my suggestion for improvement here would be to use this foundational value proposition, this unusual profitability at a microscopic cap, to justify the technical levels being watched. That elevates the whole trade plan from just reactive charting to a calculated risk that's based on the underlying strength of the business.
Precisely. We have to link that technical stop loss to something substantial. For instance, the analysis should advise exploring if that suggested stop at 137 aligns with a previous capital raise price or, and this is critical, a specific cash-on-hand benchmark.
Okay, could you elaborate on that, the cash-on-hand benchmark? What would that look like in terms of, risk management?
Well, if we can determine that a breach of 137 pushes the market cap down to a point where its value is less than, say, the company's net tangible book value.
Okay.
Or specifically, less than the critical operating cash they need to maintain regulatory compliance, then hitting 137 becomes a systemic alarm. It's no longer just a technical failure, it's a fundamental change in the entire thesis.
So the analysis should say something like, a drop below 137 signals a market cap below X, which might question the long-term viability of their recent profitability.
Yes, that's it.
I see. That gives a non-technical, a financial reason for cutting losses fast, which is way more convincing. Does this same principle apply to the upside targets, like the 167 breakout and the $2 target?
Absolutely. The same rigor has to be applied to the upside. So instead of framing 167 just as technical resistance, frame it as the minimum valuation correction needed to reflect that recent positive net income quarter.
Okay.
So, for example, if we knew that before this last profitable quarter, the stock was consistently trading between, say, 160 and 180, then breaking 167 isn't just about overcoming resistance.
It's the market finally waking up.
It's the market finally starting to recognize and price in that positive shift in earnings.
So holding below 167 implies the market is just actively ignoring the good news. But breaking it means the market has no choice but to start repricing based on the new reality. That gives those technical lines a real narrative power.
It does. It makes them meaningful milestones, not just arbitrary trading ranges. The current analysis has all the components of a phenomenal thesis. We just need to bolt them together so the foundation supports the entire structure.
That creates a much stronger argument for anyone considering the trade.
Without a doubt.
That integration point closes the loop on the trade mechanics really nicely. But let's step back from the numbers for a moment, because the second major area flagged was the tone.
Ah, yes.
The material uses this very exciting, high-energy, opportunity-focused tone. It calls the move a breakout alert and talks about the stock having ripped back up from the lows.
And I recognize the attempt to capture momentum, which, is vital in microcaps. I get it. However, that aggressive, speculative tone risks undermining the analysis's credibility, especially when you're talking about complex, non-guaranteed catalysts like the Safer Banking Act.
I wonder, though, if we tone it down too much, don't we risk losing those momentum investors we're trying to attract? In this space, energy can often signal accumulation.
That's a fair counterpoint. But the weakness here is that highly speculative language, like predicting it can double overnight, or just asserting the only way is up.
Yeah, that's a bit much.
It creates unnecessary pressure, and it reduces the perceived analytic rigor. The analysis is asking someone to commit to a potentially volatile technical trigger while also relying on a major non-guaranteed political event for the payoff.
Right. If that political news doesn't drop, the technical setup is suddenly way less compelling in the long run. The language has to reflect that calculated risk.
Exactly.
So the solution isn't to kill the excitement, but to ground it in a conditional reality. We're looking for calculated, risk-adjusted optimism, not just pure hype.
Precisely. My suggestion for improvement is to maintain the focus on the opportunity, but introduce more tempered, conditional language when discussing future catalysts. This shifts the perception from pure hype to a demonstration of calculated conviction. We need the conviction, but we also need realism about how politics moves, or doesn't.
So how can we refine the discussion around safer banking to hit that balance? Instead of just saying, if any positive news drops, what do we do?
We need to introduce specific, verifiable milestones that would actually move the needle. When you're talking about safer banking, rephrase it to reflect legislative progress.
Okay.
For instance, instead of vague positive news, the analysis could state if the bill progresses out of committee and nears a Senate floor vote, that verifiable political momentum would immediately force a valuation reassessment in this space.
That's specific, it's measurable, and it links the catalyst directly to the predicted market reaction.
And that substitution just instantly elevates the analysis. It shows a deep understanding of the regulatory landscape, not just a hope for some good news.
Yeah, I also noticed the material used these highly emotional terms, like calling SHFS a penny stock that just woke up.
And those emotional terms are just better replaced by language that reflects the actual technical and fundamental state. This is an analysis report. It needs to convey some seriousness.
Right.
I'd suggest replacing those simplistic emotional terms with something like a microcap equity showing early signs of institutional accumulation against a persistent sector headwind, or maybe a technically compressed stock positioned favorably for a policy shift.
That shift in language validates the deep expertise the writer clearly has. It signals this isn't just a fleeting alert, it's a deeply studied potential pivot based on market structure.
That's a phenomenal way to frame it. It signals a focus on market structure, not just daily volatility.
Okay, so we've improved the buy-sell mechanics and cleaned up the language. But what about the elephant in the room, the persistent bearish sentiment?
And that leads us right to the third point. The material correctly flags the key risks. That 5% after-hours drop, and the fact that the one-year chart is, quote, still ugly, until the stock can break and hold above that key 180 level. And that acknowledgement of risk is essential.
It is, but while the material correctly notes the long-term trend as a major risk, the analysis of why the one-year chart is ugly and what that 180 resistance level fundamentally represents, that needs crucial contextual depth.
Right.
Precisely. The weakness is that the current analysis only mentions the effect of the downtrend, the ugly chart, and the 180 hurdle, without exploring the deeper, fundamental cause of that persistent selling pressure. We've all been there staring at a chart that looks like a ski slope.
Right. But knowing why it's ugly actually validates the bullish thesis if it succeeds. Was the sell-off caused by past dilution events, a collapse in the broader cannabis index, or maybe previously missed earnings targets? Without that context, 180 just remains an arbitrary line, not a meaningful psychological or financial hurdle the market has to overcome.
And if the analysis can pinpoint the cause, it allows the person reading it to judge the strength of the current reversal against the specific historical weakness that created that 180 wall in the first place.
My suggestion for improvement is to strengthen the bear case by briefly contextualizing that one-year trend. Make sure the person reading understands the financial significance of breaking that 180 resistance. It's not about writing a whole paragraph on history.
Just a sentence or two.
Just one or two specific, impactful sentences of context.
So let's focus on that 180 hurdle. How can we tie that number back to the company's past in a meaningful way?
Well, we need to connect that price point to a concrete historical event. For instance, the analysis should advise exploring if 180 was the exact price of the most recent significant capital raise or a dilution event.
Ah, okay.
If 180 is the price where the last major wave of shares was issued, then breaking that level signifies that the market has finally absorbed all the outstanding shares from that event. That is a concrete psychological and financial barrier.
And overcoming it signals that new money is willing to pay more than the last institutional investors paid.
Yes, that elevates the relevance of 180 dramatically. It would mean that breaking that level suggests the dilution overhang is finally cleared. If the writer can confirm that 180 was in fact a dilution price, that is an insight worth prioritizing.
Absolutely.
And let's not overlook that 5% after-hours drop that was mentioned in the risk section. That detail needs to be integrated too.
Right, the drop down to 153?
The analysis has to address whether that drop is just a continuation of the year-long weakness, meaning the technical bounce was already short-lived, or if it's pure short-term profit-taking from day traders reacting to the small daily bounce.
And how the analysis frames that overnight movement either supports or undercuts the bullish thesis, doesn't it?
Exactly. If the material suggests this volatility is just profit-taking, it implies that the long-term investors or those starting to accumulate are holding firm, which strongly supports the bottom is in thesis.
But if it's the other way?
If, however, the analysis suggests this drop reflects continued systemic selling or uncertainty, then it fundamentally undercuts the bullish argument and makes that 137 stop loss even more critical to defend. Connecting that overnight movement to the historical trend provides a vital, immediate piece of the puzzle about market sentiment.
This whole critique really helps the analysis shift from being a high-energy technical alert to being a fully integrated, financially rigorous investment thesis. The bones of the argument, the profitability and the valuation, are phenomenal.
We're simply helping the architecture connect all the pieces, the technicals, the fundamentals, and historical market psychology into one seamless argument. The potential here is massive,